Now? So good afternoon, everyone. I'm Julieta Genke, and together with my partner, Maria Elena Isaza, we would like to welcome to our Robeco Masterclass event. We are very happy to see you all. Thank you so much for sharing and taking the time, actually, to be here. We know that it has been raining. The markets crashed yesterday, so it's tough. We really appreciate your participation. And mostly, we would like to thank you for your partnership, for your continued support to Robeco. So thank you so much. Thank you for being here. I hope that you enjoyed the program today. And hopefully, you're going to leave this program with some new insights and ideas that later you can share with your clients. I also want to thank and welcome all our streaming followers because through the Fan Society platform, we have more than 200 people joining virtually from all Latin America. So thank you, Fan Society, to helping us to promote this event. We have a pretty tight and robust agenda today. But before getting started, I would like to introduce you to the Robeco team and the speakers. So Ana Claver, Ana there. Ana is our boss, the big boss. She's the head of Iberia, US Offshore, and Latam. She is based in Madrid. Also, Karin van Baardwijk, our CEO, she will be joining us virtually from Rotterdam. She's going to be saying a couple of words. From our local team in Miami, we have Nacho Alcántara. Ignacio, I don't know where you are, there. Head of Business Management. Also Mauricio Bernal, right by Nacho. Sales and Marketing. Jessica Dennis, Head of Operations. And from our investment team, we have a pretty good lineup of speakers all over from the US and Europe. We starting with Mike Mulaney. Mike, there at the back. He is the director of global market research for Boston Partners. Then we have Ed Verstappen from our trends range of funds, popular for the global consumer trends. Then we have Eric Keller sitting by Ed from all our fixed income and credit capabilities. Nicholas Benetton representing Robeco Sam, all our sustainable products, all of your sustainable capabilities that hopefully you are going to learn more about. And last, to close the program, we have invited Sander Dubestein. Sander is a highly acclaimed top trend watcher. So he's going to be our keynote speaker, and hopefully you're going to get a lot of information, and he's going to open your minds about what is going on with all these new technologies, innovation, and everything that is happening so fast. So with that, I'm going to turn it over to Ana. Ana is going to be having a couple of words, and then she's going to be doing an interview with Karin. So with that, Ana, thank you.
Thank you. Thank you so much, Julieta. Thank you, everyone, who are here today. Morgan Stanley people, some familiar faces, so that's great. And I have the pleasure to be here on the stage with the big boss. She is really the big boss, with Karin van Baardwijk. Karin, can you hear us? It's okay?
Yes, I can hear you very well.
Okay, that's great. Thank you, Karin, for being here with us today. It's quite late in Europe, so much appreciated. And this year, it has been an intense year, I think, for everyone, for the market, for everyone, but also for you. So how are you, Karin?
Well, thank you, Anna. Actually, I'm very well, and I'm very proud and honored to be able to lead Robeco as of January this year. Clearly, it wasn't the easiest of time to take on a new responsibility. Luckily, I'm not new to the Robeco organization, so that helped me tremendously in getting started. Also on my behalf, please, a very warm welcome to all of our US offshore and Latin American clients in the Miami venue as well as online. Nothing is more important in Robeco than the relationship that we have with all of you. So thank you for your ongoing support as well as commitment. And I'm very thankful that you will spend your valuable time with us today. I think the team went the extra mile to set up a very interesting agenda with great speakers that will share their insights and knowledge with all of you today.
Great, Karin. And now we would like to know how is Robeco doing, because as we were just mentioning, I mean, it has been this year is quite volatile, but the industry itself is evolving. So my question to you is, how is Robeco doing at the moment?
Yeah, that's a good question. I think overall it's very safe to say that Robeco is doing well. In 2021, we saw that all the traffic lights were on green in terms of market appreciation, client demand, especially in the wholesale channels. And we've seen that our trends and thematic proposition blossomed as never before. That also resulted in record years in terms of EBIT for Robeco. And all of that was achieved with people working from home. And despite COVID, it was a good year. I think all of us early this year have seen that the market conditions reversed tremendously, and tailwind has become headwind quite rapidly. The mood on the financial markets has shifted significantly. It seems that inflation levels are considered to be very high and not purely transitory. So central banks are tightening monetary policy, interest rates hike, while also the global economic growth is suppressed by geopolitical tension. So it's clear that returns on financial markets are under pressure. At the same time, I believe that especially in markets that are unpredictable and volatile, Robeco should be able to demonstrate that active asset management is working and adds value to our clients. So I think our strong and diversified product range has clearly supported this throughout the various market cycles and giving us opportunities to weather the storm that we are in globally.
And I think you have just also mentioned, I mean, how we are doing today, I mean, in these market circumstances, but we would like also to know your view about the long-term trends in the industry. I mean, how you see the industry looking forward, and also your view in this region.
Yeah, we can't ignore the fact that it's tougher times than it was before, where I mentioned already that markets clearly are under pressure. But we have to accept that some of the conditions to the success are reverting, and I just mentioned a couple, right, on the interest, on inflation, geopolitical tensions. But still, I am also very positive because there's opportunity for a very broadly defined book of business that we have and the organization that we are. I think the shift from growth to value in the equity market is prominent, but we also very clearly see that our quant-driven Boston partners, also value strategies, will clearly profit from this rotation. The other trend that I clearly see here is the trend of sustainable investing. It keeps on coming back. And it takes the center stage in a lot of my own conversations, but also many of you in the room. It's not just a conversation at the desk at Robeco, or just in Europe. It's more and more becoming a global topic of conversation, which also means that we are not the only one who proclaim our thought leadership around sustainability investing. So our competition is also maturing rapidly. And that's also what we clearly see. At the same time, I'm very confident that Robeco is well positioned to also demonstrate in the various markets that we're in that we remain to be strong within SI.
Okay, I think that's very clear. I mean, the trends that you foresee for the future. And also you have been talking about Robeco, how Robeco is doing. So a mix between both questions, it will be for me to ask about our strategy, taking into account our strengths, our market environment. So if you can elaborate a little bit, what is the strategy that you are implementing at Robeco, and also your view for this region, for the US offshore and Latam?
Yeah, sure. So let me explain it in three clear messages. So our ambition is to further expand on our leadership position in sustainable investing, not just in Europe, but in other parts of the world, in the US, as well as Asia. The second part that we can define in our strategy pretty clearly is the growth trajectory that we're on, and growing our company in a very profitable way. We hear our clients' needs in the US, Latin America, and globally, and plan to increase our efforts on the alternatives and multi-asset strategy space to cater for the needs of what we hear our clients clearly need. And a third one is also being an employer of choice. I think, if anything, that we've learned from COVID is that the labor market has fully internationalized. It has up and downside. Downside is that all of the talents that work at Robeco are visible to the rest of the world. But also Robeco was able to tap into that global talent and attract new talent. Just like our efforts to strengthen our teams in Miami and with the recent hires, but also future hires to come. So it gives you a lot of potential, but you have to be mindful of not just bringing good people in, but also retaining them. It's very important for our strategy to be successful going forward, because this asset management industry is a people's business. We also recognize that there's a unique set of things happening in the US that are conspiring to give Miami an opportunity in becoming the Latin America capital of the world. And I was reading that over the past 16 months, Miami has received more than $1 trillion in assets under management by companies moving to the city, with an increase on venture capital by 200% year over year. And this demonstrates the potential of the market. And I am proud that Robeco has recognized this potential already for for over 10 years. And we've heavily invested in the past, and I'm absolutely certain that we will continue to do so in our people, in our product offering, to make sure that we can cater for the needs of all of you here today in the room as well as online.
Okay, I think that's very clear. Karin, thank you very much, because it's true that Robeco have been, had presence in this market for the last 10 years. We're quite early to be here physically with the office. And it's just because we really, this region for us is very strategic. So thank you so much for hearing those words from you. I would love to keep chatting with you, but just a matter of time. It's also 8 p.m. in Europe, so thank you so much for your time and your words here. I think our clients really appreciate it. Hopefully, we can see you next time here in person. Thank you so much, Karin.
Thank you, Anna, and to all of you, thank you again for your support, commitment. Enjoy today. Enjoy the speakers, and hopefully Sander is not going to scare you too much on some of the trends, because I know what's coming. But clearly an interesting story, and best of luck. Hope to see you next time. Bye-bye.
Okay, bye, Karin. Thank you. Okay, I will hand over.
You done? Perfect. Oh, no, I don't need that. Okay, I have this one. Yeah, perfect. Thank you, Anna, and thank you again, all of you, for joining us today. So we're gonna, oops, this is moving for me. At this time, I'd like to welcome Michael Mullaney to the stage for our first speaker again, or second speaker for the day. We want to give you an outlook. Certainly, there's a lot going on in terms of the markets. It feels like we breathe a little bit, and there's a pullback, and then we breathe a little bit again, and there's another pullback in the market. Certainly, a lot of shocks from COVID to inflation to recession. So Michael Mullaney is joining us from Boston Partners. As you may know, Boston Partners is a sister company of Robeco. And through Boston Partners, we offer you essentially solutions that are specific to value. So from global equity to all cap to US large cap and mid cap solutions. Michael is the director of global market research at Robeco and has many years of experience. So please join me to hear your thoughts about what's going on in terms of markets, and more specifically, the outlook for the economy. Thank you.
Here we go. Okay. Thank you very much. I'm going to kick it right off if I get my first slide up. On the global economy. Starting off with, and I'm going to explain some of these numbers and detail some of these numbers because I know in the back they're hard to see. So we have two sets of forecasts here from the World Bank, the IMF, and the OECD. On the left-hand side of this chart is their forecast for GDP growth on a worldwide basis for 2022, and on the right-hand side, 2023. The blue lines were the forecasts at the beginning of the year. The green lines are the forecasts where they are the most recent forecasts they've come out with. And you can see there's been a significant degradation of their prospects for the economy on a global basis since the beginning of the year. So, for example, let's take the IMF. The IMF started the year believing that global GDP growth was going to be 4.4%, and they're currently at 3.2% for 2022. You can also see a significant downdraft in expectations for 2023 as well, from 4 handles to 3 handles generically. One important point about the IMF, though, if this will come back up. The IMF, you can see in 2023, is at 2.9% expectations for GDP growth. Why is that important? Anything less than 3% for the IMF is considered to be recessionary territory. So the IMF is forecasting a global recession in 2023. Hate to be so solemn and so glum about things, but that's the forecast coming from the IMF. The other numbers are obviously very much reminiscent of that as well. Looking at regional differences between developed markets in blue and emerging markets in red. Once again, the OECD and the IMF give forecasts for each one of these territories. Same thing you can see right now as far as 2022 is concerned. Once again, relatively benign environment for 2022. What's intriguing to me about 2023 is that the IMF has got actually an increase in 2023 for the emerging markets. And what stuck out to me was they've got very slow growth for the developed markets at 1.4% for 2023, but emerging markets at 3.9%. That gap seems to be too high to me. I don't know how emerging markets is going to get a 3.9% GDP growth with developed markets only at 1.4%. So I'm guessing that that number most likely comes down during the course of 2023 relative to what the IMF has been forecasting at this juncture. This is a graph of the Citigroup Economic Surprise Indices. Citigroup economists track the global statistics for the economies around the world, and what they do is basically it's a running tally. If the statistics come in above consensus expectation, basically it's a +1. If they come in at consensus expectation, it's a null or a 0. And if they miss expectation, it's a -1. And what they do is a running tally of those statistics. And as of right now, you can see economic surprise indices are, at this juncture, not bad for emerging markets. Emerging markets is above that 0 line. So the expectations are actually the results that are coming in are above the expectations for the economists that put out those numbers. Whereas if you look at the G10, which is in the green here, the G10 is still below expectation, although it has improved. There's 2 facets to this, though, because while they're beating expectations, expectations have also come down. So they're beating a lower level or a lower bar to get over right now. So you have to keep that in mind as well. Inflation has been a big topic, obviously, in this room all day, including today, right now. On the left-hand side, you can see in dark blue the trend of inflation in advanced economies, and in the lighter blue, the trend of inflation in emerging markets. So emerging markets, no question about it, has seen a real surge in inflation during the course of this year. And the same so for the advanced economies. If you look on the right-hand side of this graph, once again, this is from the IMF, you can see their expectations in January of where they thought inflation was going to be for advanced economies, and then their April 22nd upward revision. So they went from basically a 4 handle to 5.7%. Likewise, for emerging markets, they were roughly 6%. Now they're at 8.7% for emerging markets during 2022. And a relatively significant downdraft in 2023. I will take the over on that 2.5% GDP for advanced economies in 2023. I think it's going to be higher. I think inflation is going to be a lot stickier, more pervasive, and a lot harder to get down than that number would suggest. Continuing, just like their economic statistics, the Citigroup economists also follow inflation and inflation surprises on a global basis. Same methodology, above expectations, +1, meet expectations, 0, below expectations, -1. And here's the running tally. Good news is we have seen some improvement. It was just off the charts as to how much the inflation statistics were coming in above consensus expectations. That has come down. But once again, a factor of the expectations have also come down somewhat. So we get a lower bar as far as beating those numbers. But overall, still surprising generically on the upside as far as CPI is concerned, especially in the United States, which we saw yesterday's number. While headline came down to 8.3%, core continued to go up. Core is going to be sticky globally, no question about that, but particularly in the United States, core CPI or core PCE are going to be troublesome for several more months. If you look at, the title has been lost here. The title of this is actually, supply chain disruptions basically kind of coming from the New York Fed. And it's an index of where there has been tension and supply chain disruptions. It was very high, obviously, earlier in the year. Combination of transportation, labor, logistics, et cetera, going into this. There has been improvement on supply chains. So the supply side of inflation is actually getting somewhat better, the supply side of that equation. Demand side, not so much. So demand side, what we're seeing is improvement on goods as far as inflation is concerned, but we're seeing pressure on services. So while goods are coming down, services are increasing right now, and that was evident in, once again, yesterday's CPI number as well. Karin mentioned this earlier. So how's the world responding to this? Well, central banks, they're increasing interest rates. You can see all the countries listed on the top. I think there's probably about 20 of them anyways that are listed here. And everyone except for Russia, Russia's the blue line at the top, have been increasing interest rates. Russia jacked rates up significantly early in this whole process back in the end of 2021. They have been cutting rates since then. But generically, you're seeing pressure where central banks are increasing rates still at a relatively rapid pace. 75 basis points is basically baked in the cake next week for the Federal Reserve again. And I think you'll probably see additional hikes coming from the ECB in the vicinity of at least 50 basis points going forward as well. The other thing that's going on, obviously, is that central banks, the banks themselves, the Federal Reserve Bank and other banks around the world, whether it be the ECB, the Bank of Japan, the Bank of England, are beginning to shrink their balance sheets. We had a rapid increase, as everyone knows, as far as balance sheets, once again, to fight the COVID pandemic and to increase economic activity. Those are beginning to wind down right now. The U.S., as far as the Federal Reserve, is now this month beginning to double their basically, not their purchases, but they're not going to reinvest double the amount they did back in September into October. It's to the tune of about $97 billion a month they're going to let roll off without reinvesting. So you get a combination of supply coming into the market from the Fed not reinvesting per se as far as their cash flow is concerned and their maturities. And there'll be additional issuance coming from these various government entities as well. So we're seeing QE turning into QT. The effect of this, there's a wide band of estimates as to what this effect will be from an interest rate standpoint, but it's not interest rates going lower, it's interest rates going higher because of the QT effect. All that adds up to tightening financial conditions. This is the Goldman Sachs Global Financial Conditions Index. As you can see, we've been elevated. We've come up a fair amount, obviously, this year compared to history. Not quite as bad as during the great financial crisis or the global financial crisis back in 2008, 2007. But once again, pressures are being applied to both companies and to individuals and to basically kind of any entity that relies on the financial markets for funding and/or liquidity, and it's being challenged right now as we speak as far as it getting more tight. Morph into the global markets. This is your quilt, once again, of asset class returns going back to 2010. Right here is the year-to-date one. The only thing that's in the green are commodities, which are up 23.6%. Everything else is in a loss category. I don't have to tell anybody in this room it's been a rough year so far in 2022 for asset class returns, no matter where you were trying to hide. So the span here is value, as defined by MSCI, down 10.5%, with growth at the bottom of the barrel at minus 24.7%. It's been a rough year across the board. Correlations across all asset classes were very high. There were not many diversification benefits out there to be had, and as such, many portfolios have suffered during the course of this year. What happened in the marketplace on the left-hand side here is the MSCI earnings per share for the next 12 months. That really hasn't come down a lot. So it's not been that earnings have, basically succumbed to the pressures that we've seen overall from an economic standpoint or from a monetary standpoint. Earnings are still kind of holding in there right now. It's been a PE contraction. So on the right-hand side of this graph is the percent change in PE ratios from the recent peaks. And we're down 30% right now as far as PE contraction for 2023. The blue lines that you see here that are there, those are bear markets. And this is what happens in bear markets. You get PE contraction during bear markets, exactly what's happened this year. We have not seen really an earnings effect as of yet, though, in the marketplace. Continuing, this is the MSCI EFA index, the relative return, cumulative relative return versus the USA performance. Once again, cumulative return. Gray is the United States, and the purple color is EFA. And as you can see, it's been a significant run for the United States. That number is 14.7 years and a cumulative return differential of 213% between those two regional benchmarks. From this standpoint, you would say it's time for EFA. EFA is well overdue to outperform the United States, but you have to look at the underlying characteristics from a fundamental standpoint and an economic standpoint, and there's probably still more hair, if you want to call it, in Europe than there is in the United States at this juncture. They have more structural issues right now than the United States does. So it might be a little bit premature to jump into EFA at the expense of the United States, based upon just this longevity of EFA underperformance. From a PE, a relative PE ratio to, the MSCI All Capitalization World Index relative to the S&P 500. Everything away from the United States is less expensive than the United States. This is a differential as far as PE ratios on a relative basis. And what it really means is that the MSCI World Index is trading at about a 27% discount to the S&P 500. And it is approximately almost 2 standard deviations below average. So once again, from a pure fundamental standpoint, everything away from the United States does look relatively inexpensive to the United States at this juncture, but maybe for good reasons too. Here are a combination of PE ratios for the MSCI Value Index relative to the MSCI World Index. That is on the left-hand side. And so this is the relative PE ratio compared to the World Index. It's about 1 standard deviation below average. So value, even though it's had a pretty good run here in 2022, is still undervalued compared to the World Index from a historical standpoint going back to 1989. To compare and contrast that, on the right-hand side is the PE ratio of the MSCI, basically the growth index relative to the World Index, and that's about 1 standard deviation above average. So you've got to still, once again, the disparity that even though value has had a significant run, as I mentioned, in 2022, it still looks reasonably attractive, if not outright attractive, relative to growth as far as the 2 style benchmarks are concerned. A little bit of a controversy here. Most people think that when there's a dearth of growth, you want to buy growth. This is coming from Bank of America, and this is their factor analysis. And so on the left-hand side, you have the OECD leading economic indicator, which is, once again, has been turning down. And once again, I hate to be the bearer of bad news, but it's been 5 months in a row on a global basis, and 5 months in a row that the OECD leading index has been on the down track, especially for the United States. Anytime there's been a period of time when it's been 5 months in a row, it's been a recessionary period. So there's no question that this is kind of arguing that we're probably on the precipice of a recessionary type period coming on a global basis as well at this juncture, which is what, as I mentioned earlier, the IMF had said. On the right-hand side, though, you can see the style performance, and I want to make a point about this. Value actually does very well, has done very well on downturns, up 5.7%, the best of these categories that are listed here, from value, growth, quality, risk, momentum, dividends, small size. It has the best return over the period from 1989 to August 2009. And why do I stop in August 2009, or why did Bank of America stop in August 2009? Well, that was the global financial crisis. and a zero interest rate policy on a worldwide basis, which kind of distorted the capital markets. So growth has had a significant run for the last several years. Part of the reason is that you've had zero interest rates. And when you start discounting future cash flows at very low interest rates, those assets are worth a lot more money. So that's part of the reason that growth has had a substantial run. Whether this continues in the future is obviously open for debate, but we're in a rising rate environment, so this will be more troublesome going forward as far as styles are concerned. But the takeaway from this is that value, X the global financial crisis, has done well during global slowdowns. Once again, why stay in the U.S. at this juncture versus someplace else around the world? Part of it's just basically earnings expectations. This is coming from IBES, and it shows that their expectations for earnings growth in 2023 for the U.S. is 22.7% to almost 23%. It's one of the highest levels we see here, obviously, for 2023 earnings expectations across the board, whether it be EM, Asia Pacific, Japan, global, Europe, et cetera. I think this looks a little bit optimistic, and I'm going to show a slide in a second that says this is probably a little bit optimistic. I would take the under on this, that we won't see a 22.7% earnings per share growth for U.S.-based stock assets in 2023. I'm guessing it's going to be lower. The reason being is that, once again, if we go into recession, you are going to see a significant contraction as far as probably more PE multiples, but once again, it's going to be off a smaller base if earnings do come down, and I'm guessing that's a little aggressive at this juncture as we speak. This is earnings per share growth, basically just in a dollar basis on the left-hand side for the MSCI World Index, on the right-hand side for EM, and you can see we're just starting to tail off as far as earnings expectations. The black line is 2022, the blue line is 2023. They are just starting to come down for the World Index. More significant downdraft coming right now for EM, and therefore be more suspect about EM returns going forward if we continue to see this kind of degradation as far as earnings growth expectations for EM and, quite frankly, for developed markets as well. I think this may be one of the last shoes to fall for this bear market, is that we really haven't seen a real downdraft in earnings expectations yet. The black line here is the percent of countries with PMIs, or purchasing managers indices, in excess of 52. Once again, 50 is kind of the demarcation line for PMIs. Anything above 50 is expansion. Anything below 50 is contraction. Historically, though, markets get a little funky once you get below 52. That's why that number is in there. You can see that we're only at about 10% of the countries that report PMIs are in excess of 52 right now. Compare and contrast that with the MSCI weekly earnings breadth as far as earnings beating or missing expectations. Earnings are starting to degrade, and they should probably continue to degrade further based upon, once again, the weakness that we're seeing coming out of these purchasing manager indices at this juncture. So the macro backdrop is not very favorable right now for earnings. Maybe the very last shoe to drop will be flows. These are flows into all global equity since 2004. You can see when we have an economic downturn, and especially in recessionary periods, you get a significant outflow of assets coming from equities. We really haven't seen that yet. So people are kind of staying relatively fully invested at this juncture in equities. If things get tougher from an earnings standpoint, from an economic standpoint, my guess is that you'll start to see outflows. And between earnings being downgraded and outflows, that would probably be a signal that we're getting closer to the bottom of this bear market. I don't think we're quite there yet. Going back to, once again, the enthusiasm that's still in the marketplace for equities, these are global stock recommendations, and on the left-hand side, the scale goes from 1 to 5, 5 being screaming buys, 1 being screaming sells. And it does, historically, it shows you where this lines up. Right now, we're at 3.7, almost, obviously closer to not a screaming buy, but it's still a significant strong buy category. And once again, it's almost 2 standard deviations above average. So the analysts have not brought down their estimates enough yet as far as their buy recommendations across the board. They're still very enthusiastic about the companies that they follow. And on the right-hand side is more regional. You can see EM, Japan, Europe, UK, US, and the UK itself. All of these are at elevated levels as far as the average earnings expectation or the ranking right now. They're all between essentially 3.4 to 3.8, still elevated. So it doesn't depend where you're looking as far as the analyst is concerned. They're still enamored with the stocks that they're following right now. Most likely, if we do get into some more significant trouble from an economic standpoint and a fundamental standpoint, you'll see these ratios starting to come down. Now I'll go into U.S. politics, which is obviously a little bit topical right now, given that we have a midterm election coming in about a little bit over a month. So these are on the top of the polls as to how Congress is going to shape out after the midterms elections. And if you look at kind of the extremes, Republicans win both chambers. That's only about a 31% chance based upon the polls. Democrats win both championships. It's only about a 25% chance relative to the polls. The highest probability of what's going to happen in the U.S. Congress is that the Democrats will win the Senate and the Republicans will win the House. That's at about a 44% chance. But that's not a crazy robust number. That's still a relatively low number. So this could change over time as well. But as of right now, that's what the odds would favor from a polling standpoint. If you look at betting odds, and you can actually make bets. You can make bets yourself on what's going to happen in U.S. politics. Betting odds are a little bit more definitive here as to what's going to happen in the midterms. As far as the House is concerned, 75%, so you pay 75% for a dollar payoff if this is the case, 75% chance of the Republicans winning the House, and only a 28% chance of the Democrats winning the House. So a pretty big span, pretty definitive that everyone who's betting thinks the Republicans are going to win. From the Senate standpoint, a little closer, 66% think the Democrats are going to win, 37% think the Republicans are going to win. So it's not quite as big a span. And that's still a relatively low, these are relatively low numbers, so things could change between now and the next, let's say, 6 weeks or so. What happens to the market during midterms? This is the S&P 500 going back to 1950. Post-midterms, you can see the last 3 months of the year, you generally get a bounce in the marketplace. So hopefully that will continue to be the case this year in 2022, that we do get some reprieve from the negative price action that we've seen so far year to date, and particularly from yesterday, and we do get a bounce in the marketplace. The percentage of times that they actually go up is actually relatively high as well. The market in general, the S&P 500 goes up about 71% of the time. So anytime you can see a number above that, this is 72.2 and 77.8 for November. That's a pretty good betting odds that you'll see some positive returns coming from the marketplace at the end of this year. Let's keep our fingers crossed that that does happen. And then for the presidency for 2024, these are betting odds. And betting odds, like I mentioned, are usually more accurate than polls. As far as the Democratic nominee, 35 cents or 35% chance of Joe Biden, 18 cents or 18% chance for Gavin Newsom, the governor of California. Republicans, tighter race. 34% for Ron DeSantis, the good governor of Florida, and 31% of former President Donald Trump. So those are relatively low numbers. That could change. There's a tight span between those two, and they're relatively low. So there isn't a giant amount of conviction on any of these numbers as to what's going to actually transpire come 2024. A little bit more conviction for the actual outcome, though, of who's going to win the presidency in 2024. That's on the far right-hand side. 55% chance of Republicans, 45% chance of Democrats. If you look at Joe Biden's popularity ratings right now, you would think that that's probably relatively accurate. He's got some of the lowest ratings we've seen since Donald Trump. We'll see what happens, obviously, in 2024. But obviously, it's leaning towards Republican. What does that mean? It means lower taxes, less regulation. That's generally what happens if we get that kind of a presidency in the United States. And last but not least, Yogi Berra, one of his famous sayings, ain't over until it's over. And I mean that from the standpoint of the fact that I think it's probably still a little bit premature to jump back in the pool with both feet. It seems like we're still in the midst of, once again, central banks tightening interest rates going higher, earnings coming down. That is not a good prescription for higher stock prices. So I would still err on the cautious side for the time being until we get some more resolution on all three of those items going forward. And with that, I'll turn it over to two of my colleagues, Dave and Ed, who are going to talk about value versus growth. It's going to be a steel cage death match, so I want you guys to really get involved with this one as well. So.
Thank you, Michael.
Okay,
Cheers.
I'll take this one.
Yeah. Sí, pero este...
Oh, you can put that back up there. I'll run that back up.
Thank you.
All right, there we go. Second round. We have 10 minutes more, so we can be a little bit more relaxed.
Oh, thank you. Yeah. You got no. If anything for questions later. Don't worry. The mic? No. All right. We'll continue with our next session. I was going to say if there's any questions, we had a little bit of time, but hopefully if you stick around for drinks later and Michael's still here, you can ask him. For our next session, we wanted to bring you a panel, value versus growth. So it's a little bit of a battle. Hopefully it'll be fun and interesting. But essentially, we definitely thought it would be very timely to speak about both styles because we're certainly getting questions around both. And as a house, we offer both solutions to you in terms of styles. So hopefully very timely. Representing growth, we have Ed Verstappen, who you know very well from our Consumer Trends Fund. He represents essentially as a client portfolio manager all of our Robeco trend funds. And as Julieta, I think, mentioned, he's based in Rotterdam and has been with the firm for 11 years. David Cohen, representing Value from Boston Partners. David is a portfolio manager for the U.S. Large Cap Equity Fund. Prior to his current role as portfolio manager, he was an energy analyst. So perhaps at the end of the panel, we'll ask him a few questions in terms of energy, and obviously we'll open it up to you. But with that, I'd just like to remind you we'll have about 3 minutes for each question, and then I'll start with the first three, and then I'll turn it over to Julieta for some questions. So I have the panel for questions. All right. So I guess the first question, we wanted to start with something basic, which has to do with what is value, what is growth, and how each of you see growth style investing and value style investing. So Ed, we'll start with you.
Mm-hmm. Well, it's tough to keep on smiling after a year like this one. But I'm actually still smiling because I think the future, at least the near-term future, looks better for us. We more or less call the bottom in quality growth stocks. That's what we are in June. And so far, that's still the case. July was good and August was then more tough. But so far, that's good. But it's very dependent on how you see growth investing. For us, growth investing is actually that you want to benefit from specific trends, long-term structural change, such as the world is much more digital. Please pay attention in the last session of today. People are much more health aware. We see the rise of Asia. We want to benefit from those long-term trends, and that gives you then a growth angle. But that is completely different than a very aggressive growth style. I'm not even sure if I would advise an aggressive growth style at the moment. We really want to benefit, as you see in this graph, and this is just as an illustration, that you want to benefit from companies that grow thanks to a tailwind due to structural change. And then those earnings, and then there have to be earnings in this risk-averse climate, these earnings can compound over time, benefiting that share price as well. Typically in more cyclical exposures, which we don't do ourselves, then you have much more of a short-term time horizon in which those companies do very well. And that's in a cyclical upturn. So for us, it's a lot about this structural growth held by structural trends. But now if we move to the next slide, quickly, there is an issue with trends that we need to be very cautious with. And the famous example is always the Gardner hype cycle. The Gardner hype cycle explains how new technology evolves. And mind you, the risk of a good trend is a hype and overvaluated stocks and over-enthusiastic expectations. And typically then you get a disappointment phase. So for us, being a growth manager, but not the most aggressive one, is actually looking for those companies that are making earnings, that can still prolong that for the long-term time, but not be overly exposed to hype situations. One thing in the COVID times that happened also to us, even though to a lesser extent than Morgan Stanley Advantage or Morgan Stanley Global Opportunities, was that some of the successful companies, even the ones without profits, became bigger in the portfolio. And that's where we had to say goodbye afterwards and take more caution since then. So at the moment we have no companies that is not profit making, and I think in this uncertain environment that is good. So I like growth a lot. We'll talk about that later, but I do emphasize, do not per se use the most aggressive version of growth, but more realistic, and earnings, and I'm sure David will agree with me on that. Earnings are very important because the market seems very risk averse. The market is not ready to believe fantasy stories.
Thank you, Ed. David?
Yeah, so in a nutshell, what we try to do at Boston Partners is buy high-quality businesses trading at attractive valuations at a time when they're getting better, when the momentum is improving for those businesses. So the firm was founded in 1995, and every single product at the firm is managed according to the same philosophy and process. So we have one central research organization that follows the principles I'm about to outline for you. So the firm was founded on 3 fundamental truths. First is low valuation stocks outperform high valuation stocks. The second is that good companies, i.e. businesses with good fundamentals, high returns on capital, profitable businesses that generate free cash, managers who return cash to shareholders and invest in high return projects, outperform businesses that have poor fundamentals, and then stocks with positive business momentum that are getting better, that see their revenues accelerating, that see their margins expand, do better than businesses with negative momentum. And the way we do that is we use an integration of quantitative tools and fundamental research to identify these stocks. So we have a quant screen that sits on top of the portfolio or on top of the firm, screens thousands of stocks every single week. And then our analysts do bottom-up fundamental research to identify stocks that have the characteristics that I outlined for you: valuation, fundamentals, and momentum. And then the quant screen on the back end is also a portfolio construction tool to ensure that we are investing in accordance with those characteristics. And on the next slide, you can see sort of a schematic of what it looks like. We call it 3-circle investing: valuation, fundamentals, and momentum. And then the next slide shows you a proof statement that we're doing what we say we do. And that slide shows you that our valuation is better than the bench, as well as our fundamentals, our returns, and the 90% of the businesses that we invest in have positive to neutral earnings momentum.
Thank you. I think the clock wasn't right, by the way, so you had a little bit more time. So we'll continue with you, David, with the next question, and that is, given the slower growth that we're seeing, the inflation that remains high, and rates probably continue to go up at least for the several more months, do you think we're in a multi-year value cycle?
I do. Nothing happens in a straight line, but we've seen, year to date, Russell 1000 growth is down 25%. The Russell 1000 value is down 10%. So that's 1,500 basis points of outperformance in a little bit more than a half a year. There's a digestion period we're going through, but the world completely changed with COVID. So investors had developed the mindset that growth was going to be low, inflation was never going to be above 2.5%, and that interest rates were going to stay low or be negative globally in perpetuity. But COVID changed all of that. We now have severe inflation. We have supply chain issues, which will be rectified over time. But the idea that interest rates are going to stay low forever is gone. And as a result of that, the excess of the last cycle is being wrung out of the system. And you're seeing that. You saw, you saw unprofitable growth businesses, not the stuff Ed's investing in, but these hyper growth businesses trading at 50 to 80 times sales they don't even generate EBITDA, no less free cash flow. And that's a relic of the past. That won't happen again until the next cycle, which is going to be a ways off. So we think the rotation into value is going to continue. And I'll show you a couple slides. So go one more. I love this slide because it basically is a disaggregation of the returns of the market. So start on the bottom. This is the S&P 500 return going back to 1971, so over 50 years of return history. The total return for the market was about 10.5% over those 50 years at compound. 7.4% came from EPS growth. 3% came from dividend growth, and almost nothing came from a change in the multiple that you paid for those businesses, right? Look at the top. This is a disaggregation of growth and value returns from 2017, which was really the beginning of the height of the growth bubble, through the middle of 2020, which was when the world basically changed with the start of COVID, or the beginning of the trough of COVID. And what you can see in green is the growth stocks returned 20.5% over that period, half coming from EPS growth, a little bit coming from dividend growth, but almost 9% coming just from the multiple expansion of those businesses. And that was a direct impact of liquidity being thrust into the system, interest rates going low. And then on the contrast, what happened with value stocks is they returned 3%, less than 3%, but they were growing almost exactly as fast as the growth stocks with better dividend yield, but the cheapest stocks in the market got even cheaper. So we had this massive mismatch between how value and growth stocks were being valued by the market, and that is now starting to decompress and unwind, and we think it has a ways to go.
Thank you. Ed, same question for you. Do you think we're in a multi-year value cycle, and if so, what does that mean for growth?
I hope not. And I also don't think so. I read an article this week actually by Goldman, and they said for the next year, let's keep it to time horizon that we can relate to. They say the difference between value and growth is going to be like close to zero. And that makes a lot more sense to me. The difficulty I always have with using large history data on styles is that it's a little bit fake. Because a lot of companies start as growth companies, and when they are less successful, they end up as a value company as well. At the moment, things like the energy sector is being challenged by energy transition. Banks, which you typically find a lot in value as well, attacked by fintech. So I think as an investor, you don't only want to look back to data, but you also want to look back to, or look into the future, because that's what we should do as an investor, have a positioning that would be good for the future. Now, having said that, this graph is actually on the past. This is 40 years, so what you see here, the difference on a global level between value and growth, in the end, it's the same. But I still get the question on multi-year differences between styles, because you can see that there's been differences between the styles over time. But you also have to acknowledge in this graph, a lot of those differences have been created in relatively a short period of time. And one period we all remember very well because it was so vivid, has recently happened, and that was the COVID time. So I agree with David on a little bit of that story, surely. In the COVID times in 2020, every technology stock, every digital stock, no matter earnings or not, went up through the roof. And we've seen the pain of that afterwards as well. So I would agree that, let's say, stocks that have very, let's say, their outlook and their earnings far out in the future, it's going to be tough for those stocks now that we are at higher interest rates. But a lot of the stocks that are also defined as growth are stocks like Apple and Microsoft. And I would not say that those stocks are overly aggressive. Actually, those two stocks are the biggest in the MSCI World Growth Index. So growth has not always to do with stocks that are maybe interesting 10 years from now. It should already be interesting today, and like I mentioned in my opening statement, it has to be now because risk appetite is very low. Interest rates are at a higher level than it used to be, probably will be even higher. So you need to be realistic, and you need to see real earnings there. And I think that's where David and I actually totally agree on. Fundamental analysis is pretty much key. And then the perspective, if it's growth or value, according to Goldman Sachs, according to me, is much less relevant. You just want to have very good companies. I like companies that are held by a structural tailwind.
Thank you, Ed. So we'll continue with you for the last question I'll give you, and then I'll turn it over to you, Juli. We've seen growth and value rotation slow down recently. Why do you think that is, given, obviously, again, inflation remains high and rates continue to go up?
Yeah, if I can use the next slide, that's really relevant. For me, the market should be, and you can agree or not agree, but the market should be the next one.
Sorry, I don't know how to go back. That one.
This one is good.
Okay, sorry.
About investors being forward-looking. So the view that interest rates would go up, which typically is contributed to value being good, that view has already been playing the markets for quite a long time. The Fed did not react because they were talking about transitory inflation, but the view that interest rates would go up was already impacting the markets for 1 year, 1.5 years already. Now the thing is, and that's what this graph shows, by the time they finally start to raise rates, the market participants like ourselves are very much well aware that interest rates will be higher. Look at Europe last week. The central bank raised 75 basis points. That's unheard of. The next day, the markets went up. So I'm more or less saying here that the market, if it's forward-looking, it should not focus on so much what's happening today. No, as an investor, you want to have a view on what's happening, I don't know, but in theory, 6 to 9 months ahead from now. Because the market is a leading indicator to the reality in the global economy. And that means that the market participants change topic, and the main topic interesting for next year, and I think Mike Mullaney point to that, is how much will the economic growth be impacted? And now the thing, if the economic growth is much more subdued and moderate, I think you have to be careful with cyclical exposure. In value, you also have defensive value. I would very much favor that, but I would honestly not value or like to have a lot of cyclical exposure. In a slow growth environment, companies that can still grow despite the weakish economic environment, often those are growth stocks because they grow helped by the trends, they perform better in a slow growth environment. And I think that's what's reflected in the market the last couple of months. The first 6 months were very terrible for every growth manager. The more aggressive you were, the more pain you have suffered. And since June, after June, I have to say, when we more or less called the bottom for growth quality stocks, things have been not fantastic, but actually been very moderated, and I think actually growth did better than value over that very short period.
Thank you, Ed. David, why do you think that rotation has to slow down?
Yeah, so I think expectations have come down for growth and for economic growth and for for inflation. You can see it in this chart here. Mike threw it up earlier. But I think what you have to consider is that higher interest rates are likely to stay high for a while. Even if they start to come down a little bit, inflation is likely to be sticky for a variety of reasons. You've got energy, which we've structurally underinvested in for the last decade. We think the crisis in Europe is going to spread to the rest of the world when it comes to oil over the next several years, unless demand really falls off a cliff. And so we think in an inflationary environment, or intermittently inflationary environment, rates have to stay high. When rates are high or elevated, banks can earn higher net interest margins. They generate more net interest income. That's positive. 25% of the 20% of the benchmark, the value benchmark is financials. When commodity prices are high, oil stocks do quite well. And when oil stocks do well, you need capex in the global industrial complex. So you need to spend on turbines and to drill wells and to invest in renewables and sustainable future in energy. And so all of that stuff is going to drive cyclicality. So we actually think that you have to be discriminating in where you allocate capital in cyclicals during this period, but we think there are going to be some cyclical groups that work. And we think actually stock picking is going to be very important because bottom-up fundamental investing can sniff this stuff out. So so I would say the combination of sticky inflation, higher rates, and also the other thing I would say is we're back to a world where yield matters. Yield not just in terms of dividend yield, but free cash flow yield. And if you look at our portfolios and the price you pay for a stock matters, and we actually have much higher free cash flow yield than our benchmarks and than most other investors.
Thank you, Uli. So now, Ed, I think that we're going back to you. We know that you particularly don't like this type of format, the value versus growth panel, as these two sides are competing or fighting against each other. So can you tell us why? And then do you think that these two investment styles can coexist in a portfolio, in a client portfolio?
Yeah. Well, I don't like it currently because I'm the underdog with being representative of growth. So that's kind of tough currently. But I've been in very happy years, and then my colleagues from Boston Partners were the underdog, and overall we still work together nicely. Well, if you see this graph, as I call it, when I was young, I liked economy a lot. I was pretty good at it. I like psychology, and I like history. And the question, value versus growth, looks to me a little bit like this picture. Like in the old Roman days, the two gladiators had to fight each other. One of them would die, and then the other one would win. But at some point in time, that person would also be killed by someone else. It's like a fierce battle. But the reality is, to me, that a good, balanced portfolio should be very much about value and growth. So not value versus growth, but value and growth. And I would definitely say and we haven't even talked about that much, that quality, pricing power, high margins, companies with sustainable competitive advantage, you can call it stock picking. I totally agree on that. Fundamental strengths. Quality is probably the key style at the moment. And value and growth, I agree with Goldman Sachs. The next year, that's not going to be the hot topic. Audience like you like always this battle setting, but to be honest, I don't want to be the person lying on the ground, but I also don't want to be the one in the top, because I know some point in time I would also be on the ground. You need both.
Thank you, Ed. And you, David?
I agree with that. It's a false dichotomy. I mean, if you take the edge case, the best stock in the world would be a very high growth business that has high margins, high returns, generates a ton of cash, gives it all back to you, and trades at 1 times earnings. Is that value or growth? It's both. And so we actually look for businesses that have some growth attributes, but that are trading at valuations that we think are a discount to their intrinsic value. I mean, a lot of the themes that you'll hear, that you've heard Ed talk about, that you'll hear Sander talk about, the digitization of the economy. I mean, we're playing those in our portfolio just in different ways. We're playing them through semiconductors. So, these are businesses that are basically, they're the industrial widget for the global economy as it digitizes and we enter the age of AI. And so what we're seeing is businesses that trade with 60% gross margins, 40% EBIT margins, that generate huge returns on capital and generate cash and return it back to us. And so, those are businesses that trade at 7 to 10% free cash flow yields. We don't have to pay 30, 40 times earnings for them. So, yeah, so I think it's a false dichotomy. And I like this slide because it also doesn't really matter, right? Like, what we do is an all-weather investment approach. So you can see in green, this is our excess return in different environments of when value outperforms growth in green, and then in blue, when growth outperforms value. And certainly when value outperforms growth, our portfolios generate excess return in a hyperbolic fashion depending on the magnitude of that outperformance. But we also outperform in most environments when growth outperforms value. In all periods, we do it by 43 basis points. In periods when it's greater than 5%, we do it by 54 basis points. It's only at the edge case, which is the environment I described to you pre-COVID and then during the tech bubble, where our strategy struggles. And that's an environment where a myopic view that there's going to be low growth, low interest rates, and growth is going to go on at high rates forever, or low rates forever in the previous period, is persistent. So false dichotomy, I think there's place for both in an investment portfolio, and it's just a matter of the quality of the manager doing the capital allocation.
Thank you. So to close, I have one last question. Let's continue with you, David. Let's discuss a little bit more on inflation. Clearly, inflation is proving to be stickier, less transitory as we thought before, or as we were told before. So with that in mind, where do you think that are investment opportunities? Where do you see opportunities?
Yeah, so what we're doing on the inflation front is really looking for stocks that fit 2 sorts of categories. The first is businesses with pricing power. Ed mentioned some of these. High quality businesses that have the ability to price ahead of their cost input increases, that are high quality, that have moats or sustainable competitive advantages. That's one category. And the second is companies that benefit directly from inflation. Energy, commodities, businesses that sell into the energy and commodity end markets, industrial equipment, machinery, things like that. If you go forward 2 slides. One more.
Sorry.
Yeah. So you can see year to date, pretty much any cyclical sector of the economy. This is the Russell 1000 values year to date performance by sector, whether it be materials, tech, industrials, financials. The exception is energy, and then consumer discretionary. They're down anywhere from, call it 10 to 25%. So we're starting to see, our value signal is starting to signal for us. We're starting to see very inexpensive stocks. We're starting to see 1 times price to book businesses for companies that have over time grown book value and not experienced write-downs. We're starting to see high single digit, low double digit earnings multiples. We're starting to see double-digit free cash flow yields. These are all things that get us excited as value investors. And we're starting to see quality businesses trade there. So when I talk about the 3 circles, I would say value signal is firing, fundamental signal is firing. The circle that isn't firing is momentum. Momentum is negative, the outlook is deteriorating, and so this is what differentiates us from other value managers, is we have the discipline to sort of wait for momentum signal to shine so we don't get caught in value traps. And so we have a list of stocks, we have a shopping list of stocks, we have cash available and stocks we're ready to sell to buy more aggressively in the cyclical groups, but we're waiting for momentum to start to turn.
And
Where do you see opportunities?
Relating to inflation, that's probably the biggest issue. I think the view on interest rates have been well known in the markets already, so we need to move on, and that's slow economic growth, if not even negative. And pricing power is then key, so I agree with David totally. So we find that especially in product market combinations that serve consumers that are a little bit more upscale, so that recession worries touches them less. So for instance, luxury brands like LVMH or Richemont with the Cartier branch, they can fairly easily raise prices too, and then benefit still maintaining their margin. In general, also companies with high margins anyhow are very relevant, protective in an inflation environment. I'll give you a very simple example with some easy numbers. Look at a company like L'Oreal Cosmetics. Their margin is roughly 60%, that's reality. They sell for 60% margins. So suppose they sell something for 60 and their production cost is 20. Suppose they have inflation and the production costs go up by 10%. The 20 moves from 20 to 22. Do you then really think that's really going to hurt that company that is selling the product anyhow for 60? Or maybe they also increase it to 62 or secretly to 63. So pricing power is one. High margins, that leads directly to good cash flow, that I agree with David on, surely. Those are segments that we are really focused on. I think you need stock picking. Those are growth stocks, but not the most aggressive ones. I again repeat that point. I'm in favor of growth, but not the most aggressive versions at the moment, because the risk appetite is just low. And there's also categories that more or less benefit from inflation, and a very simple example is payment companies. So payment companies, if we are in a slowdown or recession, obviously you would think the number of payments goes down, that's true. But at the same time, prices have just gone up by 8.5 or 10%, and those companies make their fee on the nominal amount of payment. So that's actually a pretty good protection mechanism for high inflation, because it increases directly their revenue. So I think inflation is going to be the biggest issue. If it takes too long, this is going to be hurtful to almost everyone. But pricing power and companies that set their own prices, and that's where I personally don't agree with David. I'm a little bit more cautious on energy for that matter, because that's a commodity price. You don't set the price, it's given to you. We like companies that set their own prices. But that's because we focus on what we call structural winners.
Thank you, Ed.
Any questions from the audience?
We want to open it up.
Yeah.
If you guys think that we have to play growth and value together, what would be the asset allocation between them? 50-50, 70-30?
90 value, 10.
Well, you want to answer or I go first?
Yeah, go ahead.
Yeah. First of all, it's not two. I would say quality is a big item too. And in the current markets, if I mention these three, I would say 50% quality, 25 value, 25 growth, if in that sense. And why do I call it like that? I have a good example. We just won a large mandate in our strategy, 1.3 billion. One of the most sophisticated investors in the world from the Middle East. Huge, huge client. And they are looking into growth, and they put 1.3 billion in there. That was because they want to rebalance over the last year. So the structure that they've had for many years, and these guys are not into timing, these guys are making into good portfolios. We have been lagging as growth over the last year, so now they want to rebalance. This grind is so big, that's 1.3 billion. So to me, it's more on not trying to time, which is a little bit your question, with all respect. I would always say, make a good combination that fits that client, what they feel comfortable with, and then every now and then you need to rebalance. You would have made very good returns with value as well in the bad value years, in the value winter as they call it, because if you every now and then rebalance, you're averaging. And I know one thing from economy, averaging is not a bad thing.
Thank you, Ed.
Thank you.
What about you, David?
I think we're 6-7 months into a growth to value rotation. These are long cycles. the growth outperformance of value lasted really since QE started in 2009, with intermittent periods of value outperformance. But I think it's very early days for this, and I think the unwind has a lot longer to go. And I think the price you pay for businesses, for stocks, is much more important today than it was over the last 10 years, because capital is more scarce, so the cost of capital is going higher. And that's typically bad for businesses that have most of their value in the tail, in the out years, and that's growth stocks. So I would be heavily overweight value, personally. I am today. And so that's my answer. I would say, well over 50%.
So I have to correct my colleague David here a little bit. He says that's growth stocks, that's simplified. That's the aggressive part of growth, and I think you need to be aware of the real earnings currently. We also are not very optimistic on the aggressive side of growth currently, because simply risk sentiment is poor. So it's not good to take the highest risk. Don't go all out on growth, but if you combine growth with quality, I think it's a good way to do that and also have value.
And to temper that, I agree with Ed. I think, when you look at businesses like Microsoft, like Google, I mean, these are high quality compounding businesses that aren't that expensive. They're not. I mean, we own Google, we don't own Microsoft. If Microsoft got to our free cash flow yield target, we would buy it, right? So I do think there's room in portfolios for growth, and it's not something you want to eschew, because the power of those trends over time do compound. But I just think it's a matter of the starting point of the valuations, and value stocks are still very inexpensive.
Maybe I can make one extra comment on it. I think when you don't want to own a specific stock, and when it's moving category. Meaning that a lot of companies start as growth funds, you pay up for that, and then they disappoint, and they start to become very cheap, and in the end, the value manager is going to buy them. That's the phase where you don't want to be. You might want to have it when it's already cheap. That would be the value manager. You also want to have it when it's actually more expensive, but it's actually also very successful. The best days of Apple were when their valuations was high, except in that phase where you move from one category to the other. That would be the worst phase, because that means that the earnings are disappointing you anyhow, and the stock will be derated considerably because you move from growth to value. It's a different investor group, not willing to pay a higher valuation. Those are the most painful stocks. And we've seen some of those examples as well in the market. That shift, that's where you really want to be don't want to be. But once it's more stable, you're good.
Thank you, Ed. Any other questions? We have time for oh, sorry, Jerry. Go ahead.
Thank you for that. I always like to bring it down to company level. I always like to bring it down to company level to get an illustration. For example, you've touched on L'Oreal. You mentioned another company. If you could give us one example of a stock that you are excited in your field. Let's say something value. Say this is outstanding, and you as well, Ed. Thank you.
Okay.
Yeah, so Qualcomm is a large holding for us, and the stock has underperformed this year, but we think it's extremely cheap relative to its long-term prospects. So this is a semiconductor company. They make the brains of the chips that go into smartphones. But what's happening behind the scenes is they're diversifying into other end markets. They're leaders in IoT, they're leaders in auto. And so what's happening over time is they're entering higher growth markets, which have higher margins as well. And so the profitability pool of the business is diversifying over time, and we think that's going to lead to much higher stock rating, a stock multiple over time. So it's a 60% gross margin business, 40% EBIT, 35% EBIT margin, with very high returns on capital. They buy stock back, they give cash back to you. And we think they're positioned to dominate over the next decade as some of these other end markets start to fire.
Yeah. I actually agree on semiconductors. So that means that value versus growth is not that black-white anyhow. So we actually agree on this. I would like to mention a specific thematic, and that is what we call pets. Pets are that 70% of households in the States have a pet, or a cat or a dog. People are very willing to spend on their pet a lot. In the corona times, this even accelerated. There's also demographic favorable development, such as more and more single households. Single people also often have a cat and a dog, and it's their main companion. They spend money on it, it's like their child. In an economic downturn, this is a growth trend, but in an economic downturn also really resilient, because people are very hesitant to cut expenses on their children, and for some people, pets are like their children. So it's nice if you have a dog, you come home, it comes to you, you're very welcome, it's your companion, doesn't cheat on you, so it's all pretty cool. So I think we look for trends that explain the story behind the company. And I think in this case, you can find quality companies in markets that tend to be oligopolistic. There's not too many companies, but a few, so that means pricing power. People are not so price sensitive because it's their beloved animal. And it's a growth trend anyhow, already for a couple of years. This is not new in our portfolio, we've had it for many years, but very favorable looking into next year. So that's just an example of forward-looking statements on a thematic basis, and I think that's what I like in our type of strategy.
Great, thank you.
More questions?
You said
Maria.
momentum, that
Yeah.
you're not seeing momentum. What do you call that? I mean, when do you think you're going to start seeing momentum? What makes you think that, oh, momentum?
Yeah. So, so momentum is often characterized by price momentum, which is just the price of stocks. But what we're looking for is something more underlying. We're looking for improvement in earnings expectations, the company's beating and raising. We're looking for expansion in margins. We're looking for revenues accelerating. We're looking for businesses, managers making capital allocation decisions. So it's really a bottom-up look into the business that shows that their prospects are improving in the future. And it's really sort of the art of what we do at Boston Partners. So a lot of people, valuation is easy to figure out. You can look at what the company's earning and figure out what the multiple is. Most people can agree on whether a business is high quality or not. There's some disagreement there, but for the most part, people get that. But that view on momentum is really something that we spend a lot of time trying to suss out, because it helps us avoid stocks that are going to be going down and stocks that are going to be stuck at low levels for a long time. So it's really a change in the underlying prospects of the business that we're looking for.
No more questions?
I have one final question for you. If there's no further questions, I'll ask you one on energy, given your background, if you don't mind, just touching a little bit on the sector.
Yeah, so we love energy long term. We think we are nowhere near through, even begun the capital investment cycle that's needed to fix the global energy markets. We have a power and gas crisis in Europe, and we think there's an oil crisis that's likely to hit the globe oil and gasoline crisis that's likely to hit the globe over the next several years. My caveat is that demand doesn't really go down, that we don't have a deep, deep recession. We're still running 2 million barrels a day below pre-COVID demand levels for gasoline, or for global oil demand, and we think that's going to recover over time, even if we have a recession. And supply, we just have not grown the supply base. We haven't invested. Coming out of the shale boom, what happened was investors really put pressure on these company management teams to rein back capital investment. These companies were putting huge dollars into exploration and into drilling in lieu of just generating returns on capital. And that led to an environment where investors basically staged a rebellion and changed the incentives by which they're paid to shift towards better value generating metrics. So cash flow per share, production per share. So all of that's to say is the supply base is being held back by more responsible investment, and demand continues to grow. And unless we invest, we're not going to be able to supply the globe with oil. And we think sustainable investing for the future is important, but not at the expense of hydrocarbon investment, because all that does is destabilize the global investment landscape and global economy. And so we think oil prices this winter could be much, much higher. The U.S. has been releasing oil from the Strategic Petroleum Reserve at the amount of about 800,000 barrels a day. It's a huge amount. That's going to stop in October or November. After that, they're going to have to refill what they've depleted, which is 50 plus million barrels. And so we're going to see a strong demand pull, and we expect oil prices could be above $100 for many, many years before we fix this, absent a major demand recession.
Thank you, David.
What do you think about seeing more and more electric cars? Will that do something to the oil?
It does. It's having an impact, but it's a slow impact. So you think about the scale of the cars on the road. Even if electric cars are a growing percentage of the percent sold each year, it still only puts it's a fraction of the cars in place. So oil demand is going to continue to grow even with EVs for many, many years. Eventually there will be a tipping point, and so we're cognizant of that. We call it the terminal value of the business. But when you look at energy companies, they're trading at anywhere from 15 to 25, 30% free cash flow yields, which means you're going to get the cash back from that business in the next 3 to 5 years to cover the entire market cap. And so you're incented to invest in energy because the returns are going to be so high over the near term, even if the terminal value in year 15 is zero. So we think there's a real value proposition to invest in energy. We think investors are under-allocated to the sector, and we think a lot of that has to do with ESG mandates and other things, which we understand, but we think there's an opportunity there, and so we're trying to take advantage of it. And frankly, it's been a huge alpha generator for us over the last 2 years in our portfolios.
Maybe Ed, you have
Yeah,
some
well,
comments?
I have a more personal anecdote on this because I had to order my new car. So my company pays me some money to order the new car, but only if it's a fully electrical one because we are Robeco, sustainable, blah, blah, blah. So I can only get a new car when that's relevant for fully electrical. I ordered mine last year in November. I still do not have it because of issues with semiconductors and supply chain. I hope to get it next month. At my house, there's already this charger. I already have that, but I don't have the car yet. So I would agree with David that actually, while we're in this process, which will be a huge growth trend, but the number of electric cars is currently fairly low. I think like 4 to 5% of all cars are electrical. On the other hand, you also know that states like California have said that in 2035, every new car sold, a new car, needs to be fully electrical. Of course, this is California, and not every state is like California, but this is relevant. In Europe, we already have that quite a lot. Like my company is only supportive of electric cars, like I mentioned. And in China, this is also quite a big thing. But that doesn't mean that you don't need the traditional energy because we come from such a low base. Even if the 4 or 5% goes to 10, which would be doubling, that's pretty cool, but it would still be only 10. But I think you can invest from both perspectives in it. Energy, traditional one, and the energy transition, both. It's a clear trend. Well, the reason I had to also not, let's say, get the electric car is not only my company, but also my daughter, and she more or less says, well, you better take an electrical car. It's that generation. They are very good sustainability. In the end, I have no power at where I live, so I had to do it.
So thank you so much. Ed and David are going to be around. Now we're going to a 15 minutes break. Feel free to step out. We have some snacks outside, but please be conscious of time and come back in 15 minutes.
I know you have to go.
Yeah, well,
you said you have
I'm
to
going
go.
to stay in a break because